Okay, welcome back to my screen, and now we're going to move away from specifically Forex. And as I said, look at what I mentioned earlier. I know we've had some people join us since we first started. We're going to go back and, as I said, look at the indices and some stocks. And I also want to have a look at a volume pattern. And if you don't do so already, may I suggest, if you have a Twitter feed, is do give me a follow, because I do have a lot of communication from traders who use VPA. This is both independent traders, prop trading firms, and they often contact me and highlight how they use volume price analysis. And lately, I've had quite a few tweets from them with actual charts, quotes from the book, which is great. What they call the volume patterns that they have identified, how they've been using them, particularly in the accumulation phase. And I'm actually going to have a look at one particular stock. In fact, I was going to do this a couple of weeks ago because I was asked to comment on it, and it's a company called Unity Software, which is quite interesting. So and also on my Twitter feed, much more so than any of the other social media that I have, is I do have this direct connection with traders who are, at their screens every day, as it were. Sorry, just hold on a second. I could hear myself coming out in different speakers. It's bad enough just one speaker without coming out in multiple speakers. Anyway, on the Twitter feed, what I'm trying to say is you will see actual examples of volume price analysis as is being used by other traders. And as I said, I do like to share that with the community. I think there's about 15,000, David, 13, 14,000. There are a lot of traders there, and it's great. And I can't tell you the thrill it gives me when, there's one more VPA trader and they are doing really, really well, which is fantastic news. Right, as I said in the previous video, everything's been rallying. Indices, growth stocks, sectors, the Russell 2000, the ETF for the Russell 2000, which is the IWM. But I'm not going to go through why it's been, how it's working out and, what to look for. Is basically I've just done a massive blog post about this whole aspect of the market. You see, it went up on the 15th of August, and it's got masses and masses of charts, which as I said, I don't want to put up now, but it will give you some background as to the current rally. There are reasons. It depends who you read. You will either read this is a bear market rally, and by that what they mean is, if we go back to the big crash of 2000, when the Nasdaq lost, I don't know how many percentage points, was it 90? Did it lose 90% of its value? Or I'd have to go and look that up. But in any major reversal, you do get very, very sharp rallies to the upside, and some of these traps, and it's when investors think, oh gosh, right, we've had our 20% fall, now it's time to go back up again. But in fact, in the bigger picture, that is not the case. Now, this bigger picture is not going to play out in the very short term. We could be talking 1 to 2 years here. It's really difficult for investors. It's a really difficult time for investors. For traders, it doesn't really matter. If it's going to reverse, you trade the reversal either to the upside or to the downside, but it's very, very tricky for investors. And at the moment, we are in one of these rallies. Whether it's a bear market rally or has also been suggested is that it's a short squeeze. There are some very, very big players who are short, heavily short, and you get this squeeze when even bigger players decide to come in and buy. You've seen that with meme stocks, and in fact, meme stocks seem to be back in fashion. Those of you who've been following that's part of the market. These are the Wall Street Bets guys, the Reddit guys. They specifically go and look for very, very heavily shorted stocks, and because through sheer mass of participation they will start buying them. They tend to be quite volatile stocks anyway. GameStop was one of them. AMC, Bed Bath and Beyond is a popular one. I think it went up 75% yesterday, massively. They specifically look, and that is what a short squeeze is. It's where you have big hedge funds, big traders are all very heavily short, then the price starts to reverse. It's a battle. It's an internal battle between different market participants. Now, when you get a short squeeze, as a lonely trader, you can actually take advantage of it. Again, you look at the volume. Will you see the volume going in the short squeeze? There's absolutely no reason why not, but you have to be aware that that is the reason why it's going on. And the shorts, if they want to stay short, they have to cover those shorts. They have to actually go and buy, and then that actually feeds into the buying rally, as it were. So it's a lot of gamemanship, a lot of playing going on by very big players. And as I said, you just have to be aware of it. Now, what I've done in this very, very long post is, with this particular rally at the moment, as I said earlier, it's heavily focused on, if you like, parts of the market you would normally expect to start rallying if you were coming out of a recession, but could simply be because we are in a bear market rally. It's a short squeeze. We won't know until it's over, but you can still look at the charts and you can still trade them. And I've annotated all the charts. So you've got the NQ, you've got the ES, you've got the XLK, which is the ETF for the tech sector. What's interesting for something like the XLK and also the longer term charts, the weekly charts, is that they're all coming up to quite significant points of resistance. So, for example, if we look at the XLK here, which is on the weekly, they are now reaching the volume point of control. The volume point of control and the histogram, it's the density of volume that is built up over time. And at this point, it's over the greatest amount of time. And what it does, it will make price action more sluggish. And also, I mean, prices will always move more slowly going up than they do when they fall down. What I also cover in this particular post is the importance of historic old price levels, particularly on the slower charts, because when the price approaches that level, as it did here, as I said on the XLK, if you look back to the left-hand side of the chart, well, actually, do you know what? It was also a period, there was a bit of a pullback, but it did actually provide a springboard. So you get, if you like, a very nice double bottom. Never underestimate the importance of these slower time frames. So there we are. That's then I go on to there. Then I go on to the ES, which is obviously the E-mini future for the S&P 500. And then I move on to what I call the US 2000 from my MT4 platform, which we'll have a look at in a minute, because this has actually been in a tremendous uptrend. As we can, if an uptrend is higher highs and higher lows, there's no disputing that. Compare it to even the NASDAQ and the S&P, where there have been periods of, it's been in a consolidation, but this has been sort of powering higher. And the ETF for it, which is called the IWM, exactly the same. It's been in an uptrend, and you know the volumes have been. I know the volume doesn't look fantastic down there, but you've got to look at the the millions that that actually represent. And I'm not going to show it now. I'll show it in another session. If you use FinViz, that will tell you what the volume is, or the actual volume is on a daily basis. You can read it off the NinjaTrader platform, and all platforms should be able to tell you the actual volume. But more importantly, it tells you whether that's an average volume. Is it average? Is it below average or above average? And it tells you whether then that's kind of there's validity behind that that volume. And then I go to explain about the significance of the Russell 2000. But the most significant part of this is the Russell 2000 is up 16%, but the S&P 500 has only gained 13%. Now, money pouring into, as I said, speculative small cap stocks, you know, it tells you something about the psychology of the market. That psychology might be wrong, and we will discover if it is wrong simply by seeing, well, you know, are these people all going to be trapped on the wrong side of the market? Right, that's what I want to say on that one. Let me just find utility, and I don't think Cisco's come out yet. I'm waiting for the, let's see, no, Cisco is still there. My Cisco blog post goes from May, and as I said, it's got a if we don't catch the earnings release, then what I'll do, I will do a separate video on Cisco. Right, where is it? I was asked to comment on this stock. A lot of the stocks, a lot of traders are attracted to are what we call a fallen angel. These are fallen angels from an IPO basis. You can see here this was launched in the market back in what was it, November 2021, so it hasn't been around a long time. But if we look at what it got to on the IPO, I'll just move my little thing out of the way, which I can't, because I can't see here. Hold on a minute. No, won't let me do it. Hold on. It basically got, let's have a look at the weekly chart, because I can't see it. I've got my GoToWebinar thing on the front of it and it won't let me see it. Right, over $200. Yes, here we are. It IPO'd at 40, went up, came down, then it had this massive ramp up, you know, great, lots of volatility, you know, there it is. Look at that. I mean, if you want that as a classic trap candle, you've got this candle which is totally out of you know, whack with all the other candles. Look at the volume underneath it, compare it with that one. That's half the size, not much difference. That's not really half the volume. And what do you think that is going to happen there? Well, that is a massive trap, and it's just been a, you know, a ski slope all the way down. But as always with these stocks, you know, fallen angel stocks, IPO stocks that, you know, go to the moon and then crash down. Investors, traders, they're attracted to them because they think, oh wow, that stock was $200. Look at it now, it's only $40. Well, you know, is it time to buy? Sometimes it is. You can't say it isn't, because, you know, maybe it's below the IPO. Maybe that's, you know, that is the time to consider going back in. This is not, you know, a recommendation. I'm just simply outlining to you the kind of psychology that goes on in people's minds when they see a stock like this. And certainly if it's something that goes up to 200 and it's down at $1, wow, that's even cheaper. You have to remember, things are cheap for a reason. But anyway, I was asked to comment on this because we were looking at volume patterns on an accumulation. So when accumulation happens is where the a stock in this case simply goes sideways. It's had a big fall lower, and then gradually, sometimes you get like a saucer shape, but you get it moving sideways, and the person concerned was, you know, he'd spotted these anomalies. This is the one that really caught his eye here, because we are looking at 50 million stock, 50 million here, and you have a tiny little candle. It's a little down candle, and if that was selling, that candle should be very wide. It isn't, so that tells you there is price support. There's always some interest expressed in this stock after this big fall. It's been in accumulation. He got terribly excited. I said, you know, well, what did I think? Well, I said, yeah, that's fine, but that's only one signal. Just wait. I have these indicators. We can see that it's at the volume point of control. David was talking about these channels, the channels that are created from by the accumulation and distribution indicator. You can see the strength, if you like, of the resistance, of the support. It's certainly got good price-based support. It's also got the support of derived from the VPOC itself, and you know, it's climbing higher. What have we got here? We've got 10 million. We've got some decent, you know, some decent volume going in. It's, you know, we're not talking a couple of 100,000 stock here. We're talking millions. We're talking 10, 15 million. I said you can check this out at Finviz, and you can see it pulled away from the VPOC. And what I actually said was, I said, yeah, fine, it looks that, but you know, wait until it certainly goes above this resistance from this this line here. And as I said, don't forget, you've got like three little triple tops there. You know, depending on how cautious or otherwise you are, you might want to wait until you get, you know, you get clear of that area, and certainly it did. And what's interesting here, although we had a little down candle here, there was a lot of volume underneath, and again you could say, well, that's anomalous as well, and you know, it's ticked higher. Now the thing to always remember when you have a stock that has had a major fall, you also have to remember there are going to be an awful lot of bag holders. In other words, the bag holders, and I don't mean to be rude about the bag, is, you know, maybe if they bought up here or they bought here and they didn't sell out, and they think, oh, well, you know, stocks are very, emotions are very curious in this market. When things are going well, we get very worried and we get very frightened. We think, oh, you know, am I going to hold on to this profit? When things are going badly, and they go really badly, and we kind of capitulate, the only emotion we have left is hope. That's how we've survived as a species, if you like. But in trading, you know, hope is not a strategy, it's not a tactic, but that's just the way it is. So just supposing you'd bought here at $80 and you think, oh, you know, great, there's a great, you know, I think it's going to go up. It's fallen, it was 210, it's 80, it's not going to go down any further. It's really a good value. I'm going to buy. You buy it, and then suddenly it halves in value, less than half, it goes down to $30. But you haven't sold out. You can't bring yourself to sell out. And I can assure you, this is a very typical reaction. You goes into this long, you know, this accumulation, consolidation phase. It happens to be an accumulation phase, and you see it start to creep up, and it's not just you who bought at 80. As it gets to that level, there will be an awful lot of traders, investors who will say, do you know what, I'm so relieved, I've broken even, I'm out. And that will add, so which is why partly stocks, you know, going up, they will always take, you know, it's more of an effort. It's not just that you need a lot of volume going up, you are going to encounter, as I called the bag, you know, the bag holders, the investors who just didn't bail out but are waiting for this reversal and will just take their $1 profit and be happy because they think, do you know what? I was, you know, I was lost 50% of the value, but at least I can say I made a profit. And the way to confirm, if you like, whether this is, you know, there's some merit, if you like, in this stock going high, you've got the same, you've got the consolidation, it's at the volume point of control, it's got, you know, looks like a solid platform, if you like. You look at the numbers going in, you're talking 80 million. You know, it's just something to look at, and you know, whether you're going to trade it, whether you're going to buy it, it's a way of looking at those volume, the kind of volume patterns that you can, you know, try and recognize in an accumulation phase. It is all explained in the book, Complete Guide to Volume Price Analysis, and as I said, it's really nice when traders, they send me a little screenshot, they send me on Twitter, and you know, I can see it. How they have implemented the volume price analysis methodology, as it were. And there's one on Twitter which I'm not sure I want to show, only because for privacy, but I will be retweeting it, and that's on the NQ, and he actually uses just trend lines. And the wonderful thing about VPA is David and I have, you know, yeah, we have our own proprietary indicators, but you can incorporate it, integrate it into your own personal methodology, trading tactics. And the nice thing about this one is you've got rising prices over, this is only the week, and you've got the rising volume. Yes, you've got the little pullback here, but so far there's not a lot of volume underneath it. So one to watch and to see, you know, whether it's going to carry on higher, and also how long it's going to take, which is going to be very interesting. I'm only going to mention, you probably noticed these charts, the white charts that I have here. Essentially, for this stock program, and we were going to do this anyway, is we are developing some more volume indicators, in particular different variations of the VWAP, and at the moment these are in testing mode, and we're I've got them on the Apple chart here, and I've also got it on, we've done one for the daily chart for the slower time frames, and so far they're interesting. They're really interesting, and we've also got what we're calling a stock strength indicator. It's a bit of a mouthful. We'll see what we can come up with, something a little bit more interesting than that. Finally, let's have a look. I just want to go back to my US 2000 on here. As I said, this is the I have on my MT4, this is the equivalent of the Russell 2000, of which the ETF is the IMW, and you don't need a special. The great thing about MT4 is it's not just indices. You've got a vast selection of stocks to choose from. It allows you to participate in markets. You don't need a futures account. You don't need a futures brokerage. You don't have to, as I said, it is on a CFD. I know there are some problems in some parts of the world with CFDs, but I just think it's a great way for you to participate in these markets. And even if you don't participate, it allows you to see what's going on in the broader market without having to pay for expensive data feeds. You know, you don't need to, you know, I'm not saying a Bloomberg terminal, but you know what I mean. You don't have to pay for I know it's on investing.com, but you can have it on your platform. And this is what I was trying to say. This is the US 2000. The reversal that we saw was back in June. This is the mid-June reversal, when markets sort of, as I said, it had this fall. Everyone was said, you know, they've done their 20% correction. That's it. It's now time to reverse. And yeah, went into the volume point of control. It's not a V-shaped reversal. You get a reversal. The vast majority of the times you have to have a consolidation phase, an accumulation phase, and when it's at the volume point of control, it's been tested, it will hold, go back here as well, it's moved away here, back to it, does fall. We've got the volume support here from the VPOC, but this is the trend. This is really in the last month or so. This is the July trend, and you know, a trend is, as I said, it's higher lows, higher highs. Volume is okay. It's now, this is the first time the 2000 has gone into, it's kind of in a slight consolidation because it's between the R3 and the S3, but the S3 is holding, and we will see whether that pushes on higher, and the levels will tell us, you know, whether it's going to carry on high. But just to give you an example of, as I said, the VPA, this obviously runs 24 hours. You're always going to get more volume during the you know, when we have more liquidity, which is obviously London, Europe, and the US. But it was just a really nice example of a beautiful break from the volume point of control, a fantastic waterfall on a rising volume, and exactly as we've seen on David's charts, you have the volatility triggers coming in, and then the sort of almost dead stop on the volume support from the VPOC. It actually it went through the S3 but stopped here. Then we have it's not a 2-bar reversal. It's a kind of a bullish engulfing candle. There's a lot of volatility. As I said, this is the FOMC, but a lot of volume, but a wick to the bottom of the candle, possibly going back to test the S3 with the Camarillas levels. These levels are now in play for the rest of the week. So the daily ones are only on the time frames up to, but not including the hour. The hour upwards to the day, they are here for the rest of the week. But it's just a really nice example of how you can use, as I said, the principles of VPA to see something like a waterfall. Now on the MT4, I've only got the time frames. I've got the daily, the hour, the 15, the 5, and the Renko chart. And the Renko chart, this is what we're seeing in terms of that move, that sort of stripped away of time. All we're seeing is just raw price action, and you have what the Renko does, it picks up the momentum because each one of those bricks is based on a value. It's not a time value, it's a value of the actual brick itself, and it only completes when that value goes through. And you can see it gets rid of all the spikes in the thing. And we've got the trend monitor. The trend monitor helps to keep you in. We're going to do a session on the trend dot and the trend monitor. The trend dots are very, very close to the price action, but together with the trend monitor, they really do help you to stay in the trade. And you know, when you are going to get those reversal points, a nice reversal point here, you've got a bearish engulfing. If you put that one over there, you've got like a shooting star. There are so many candle patterns, very simple candle patterns, and often with traders when they first start, you know, pick a candle pattern and just learn it, stick with it. 2-bar reversals, shooting stars, hammers. Read it with the volume, and that will certainly help you to at least get started and put together a trading style that suits you, and you know, will allow you to you know, test out and try out new things on your charts. Right, I'm going to stop there. That's it. I wanted to do Unity. That's fine, and I'm just going to pass over to David.
Hi everybody. Hopefully you can hear me. Anna's put a thumb up so she can hear me, so hopefully you can too. Yeah, I've answered Lisa's question. Yeah, I have indeed. Okay, I just moved the chat box out of the way. Okay, just really a couple of things that I wanted to focus on. This is a workspace for the ES. Appreciate it's 9 o'clock here UK time, so we're coming to the end, or we're at the end of the US session. There'll be a bit of follow through, but primarily, you know, the volume's falling away, and we've moved towards the end of the session. What I really wanted to highlight is this is the 15. There's several things on here. This is the 15-minute time frame for the ES, which, if you're not familiar, is the index future for the S&P 500. It is the most heavily traded. It is the most volatile. If you've not traded index futures before, I don't suggest you start with this one. I would suggest you start with the YM, or I would suggest you start with micros, which were launched maybe 2 or 3 years ago now. Very successful, very popular. They are basically a tenth the size of these contracts. So they are a great way to get into index trading, index futures, without going to the full size contracts of the ES and the YM and the NQ. And of course, you've got other futures as well with the Russell. There's two things I wanted to show you here. The first is down the bottom here. The nice thing with NinjaTrader is, as a platform, one of the many nice things about it is that it actually delivers in your local time. So you don't have the issues that you get on MT4, MT5, where you're like we are showing you something on a chart and you'll think, well, hang on a minute, it doesn't look right in terms of what time frame or what the time zone is. And it isn't. It's generally 2 hours behind in terms of what you're looking at in real time. So what you're looking at here at the bottom is actual time here in the UK. So this was 7 o'clock in the morning where my cursor was at the bottom. This was 8 o'clock in the morning. So basically, this is our morning session. This is when London Forex gets underway. So we're going all the way through here. And this point here is 2:30, which is when the US, or 1 o'clock, US markets get underway, and then the cash markets open at 2:30. So you've then got the physical markets open with the electronic markets, because these contracts trade 24/7 on Globex. And the point I wanted to make is this, and I make this point every single time I do one of these. If you look at the price action here, this is through our morning session coming through to the US session getting underway here. Look at the price action. It is measured. It is even paced. There's very little volatility. Yeah, we had a volatility candle here, but it hasn't got great wicks, the top and bottom, all the rest of it. Yes, it was volatile, but it was only volatile because it was moving quite quickly because there was some London news. But in terms of the general pattern, it's very straightforward to trade. It's not scary. I appreciate the volume down here looks minute, but that's only because it's compressed, because this has come in. This is where we've got cash and futures and electronic running in parallel, and you get this massive surge in volume when the cash markets open, which has compressed this lot. But I can assure you, at the time I was trading this, it's very demonstrable. It's perfectly tradable. And my point is this: when you look at the price action here over the London period, the London phase getting up to London 1 o'clock here and 2 o'clock as we come into the US session, and then you start to look at the price action here, it is totally different. It's almost like it's a different instrument. And what I say to people is this, because a lot of traders in the Southern Hemisphere say, well, I can't trade the US Open because I'm asleep or whatever it may be, or it's the wrong time frame for me, or it's the wrong time zone rather, forgive me. And I always say to them, well, have you ever thought about trading these markets when London is open? And look at the difference in the price action. It is so straightforward. It's not scary. It's not volatile. It's even paced. And I'm not saying it's easy to trade, but it's a darn sight easier than trading in here. Because once US markets get underway, this particular contract, this index future, is heavily subject to the automated traders. The EAs all click in here, and they are partially, not totally, but partially responsible for the huge volatility that you see every time the market gets underway. It's very rare that you can see a smooth price action to the open. You get lots of volatility candles. You have to wait 10, 15, 20, 30 minutes sometimes for the whole thing to settle down a little bit before you've actually got the confidence to jump in and start trading what could be considered a trend, which is then moving away from these volatility spikes that you see all the time. So I make the point. I make it all the time. A lot of traders would disagree with that. I'm afraid the proof is in the pudding. This chart is just a classic example. Where would you rather be trading, making money down here or in amongst this lot here? I rest my case. The other point I wanted to make about this was the FOMC release. This is a 15-minute time frame. Look at this candle you've got here. And do you remember what I said to you about overlaying candles one on the other? It's very difficult to overlay multiples. it's much easier to overlay 2. Everyone can do 2, but you can't do 4, 5, and 6, which is why we do multiple time frames, which are a key part. You see this coming in here, big volatility candle. The volatility indicator is triggered, ton of volume underneath. Now remember, with the volatility indicator, it triggers before the candle closes. So once you've got that surge in price action, this is going to appear and it will tell you that the price action has moved outside the average true range, which is what the volatility indicator does and is all about. Volatility is just a compression of time. That's really all it is. All that's happened is that this piece of price action would normally occur over, I don't know, 8 candles, 5 candles, 6 candles, whatever. And all that's happened is that that amount of time has been compressed into a single candle. That's all volatility is, but it's reflected in the volume. And the volatility indicator comes in before the candle closes. So it tells you immediately that you've got volatility, that the big operators, the market makers are in there. You're looking for one of two things. You're either looking for a reversal or if you're looking for a congestion. Now, if you've got a nice piece of profit in here, and I say this every time, and I do it myself every time, get out the market. If you've got multiple contracts running, you might leave one on, but take the bulk of them off. If you've only got one contract running, get out the market, bank your profit, and sit tight and wait. If the market carries on up, fine, you just jump back in again. What have you lost? You've lost some points here. So what? It's so cheap trading now, it really doesn't make a difference. If the market congests, do you want to be sat in congestion? No, you don't. It's painful, it's tedious, it's emotionally draining. So get out. If it reverses, that's the last thing you want to do. You'd be taken out anyway. So close out, take your profit, head for the hills, put the money in the bank, sit tight and wait. This occasion, we get a straight reversal back down to the volume point of control at the bottom here. Now, you would see that on 15. It would be less clear on 10, on that one, but I can assure you it's exactly the same sort of pattern. It's just different. You go down onto 5. All of this is combining into that candle on 15, and obviously right the way down to 3 minute, 1 minute, and so on and so forth. And that's why we use multiple time frames. Yes, you will get the volatility appearing on the 10-minute, but if you're seeing it over here, this is serious. And there's one aspect of trading which applies, and I kind of alluded to when I was talking about the currency heat map. Time trumps everything. The slower the time frame, the greater the significance. So the significance of this on a 15-minute time frame is more significant than on a 10, is more significant than on a 5, down to the 3, 1, 15 second, etc. So whatever happens on a slower time frame is always going to carry more weight and be more significant than what is happening on a faster chart downstream of it. And that applies whether it's an indicator, whether it's a volume relationship, whether it's a congestion phase, whatever it may be. That is a truism which holds across every single time frame and across indicators as well. So I just wanted to make the point, it's just such a powerful example of, as I say, the two things. First of all, trading outside of the US markets, particularly through the London, which we are very privileged. We're very, it's very comfortable for us to trade both. So we are very privileged in that respect. We can trade both sides. But secondly, in terms of multiple timeframes, and in particular, this volatility indicator, which is so powerful. It's $57. It should be $570, quite frankly, because it gets you out of so many bad situations. If you're in profit, get out. If you've got a loss-making situation, it's more difficult. You've got to make a decision, and you've got to hope that, you know, maybe it'll reverse in your favor. It doesn't always, but if you're not in the market, sit tight and stay out. Wait for the market to clear this particular. So in this example, if we've got this and we're waiting to trade back in the market again, what we're waiting for is the price to break up to the upside and away from this level here, or break to the downside and below this level here. But obviously we've got the volume point of control again. So as the market comes back here, if you're trading this short and you've jumped out and you're going back in trading short, and you might well do on this big spike here on this candle here, then the decision you've got to make is, well, how far is this market going to go? Well, you've got it down to the volume point of control, because you can be assured that the market is going to congest there. It's not going to go straight through there and fall down here somewhere. It will congest here. Why? Because you've got the heaviest concentration of volume there. And volume acts in the same way as price does. We're all familiar with price acting as support and resistance. As examples here on the accumulation distribution, which is based on price for its delivering of the indicator. So these are price-based levels of support and resistance. Volume works in the same way. So when you've got heavy volume, you're going to find congestion. Where you've got light volume, low volume nodes here, you expect the price to move through there pretty quickly, and it did. That's what you expect to see. So if you're trading this to short side and you've got that, that's great. You expect to see that, but then you've got this ahead of you and you're expecting congestion, which is what we've got. So you've got a decision to make, and every trade is set up in the same way. You're looking at it from that context. What have I got in the way of me? What is like to cause this trade? Is it going to run for a long distance, or am I going to run into, I don't know, price-based congestion, or am I going to run into volume-based congestion? You know, what have I got ahead of me in the various time frames? Now, very quickly, I'm just going to wrap up. Let me just hop over onto another workspace. Oh, sorry, not that one. That's Market Analyzer we've got set up. If you've got the full set of Ninja indicators, as I'm sure many of you know, we automatically deliver new developments, new indicators to you, so you'll get this free of charge. So if you have the NinjaTrader full package, it's something we've done ever since day one. It's just our way of saying thank you to you for investing in us with a full package of indicators. So you will get this. This is for Market Analyzer. You'll also get the VWAP indicators, you'll get the strength indicators for stocks, you'll get all future indicators, and we've always done that. Let me just go over onto the Renko. There we go. That's the one I wanted. There we are. Let's get that out of the way. This is another workspace I use a lot. I'm sure many of you are familiar with Renko. The Renko optimizer on NinjaTrader works in a very, very different way. And this is an immensely powerful workspace, because what you're looking at is on the top line, you've got 3 Renko charts, and Renko is a non-time-based indicator. It's independent of time. So what you see on a Renko chart is momentum. You don't see that on a time-based chart, because a time-based chart will time out after 15 seconds, it'll time out after 30 seconds, it'll time out after a minute, it'll move on to the next candle. On a Renko is governed by this number here. Now we've got 5 here. And what that means is that each of these bricks is 5 units. Now, this is on an ES contract. This is the same as we were looking at earlier on. This is the S&P 500 futures contract. We're on the September 2022 contract. Each of these bricks is 5. The smallest unit of trading on an ES futures contract is a tick. So this is basically 5 ticks, and there are 4 ticks in a point. So this is basically 1 1/4 index points on each brick. The next one is on 8. So that is going to be 2 bricks, because that's 2 times 4 is 8. And 13 units here is going to be 3 1/4. So basically 3 times 4 and 1/4 tick. So it's 3 1/4 ticks on each brick. So in the same way we're using time-based charts, we're actually using multiple Renko charts. And you might say, well, where do I get this setting from? And that's the unique aspect of the Renko optimizer for NinjaTrader, because you simply select the time frame. We are matching it down here to the 15-second time frame below. We select the 15-second time frame. And whereas before we had 5, this is now telling us our optimal setting. We're now out of the main session. We're moving into a very slow session. We literally click on that, and that delivers our optimal brick size. We are now on 4 ticks rather. So we are basically looking at 1 index point per brick. So it's delivering the optimal size. If I just reset these, we'll just check these. That's on 30-second. That's come up as 7 now. We click on the bottom there, and that sets us up for 7. And I do the same over here for the last one, which is on a minute. So we're now matching one with the other. Click that on there, and that pulls up on 12. So we're now down to 3 points there. And the beauty of it is you have a non-time-based chart above, which is your Renko optimizer. which gives you momentum, and yet below on all these charts here, we've got our classical time frame chart with our volume, we've got our indicators, we've got the VPOC and all the other good things. So we can actually blend volume price analysis on our time frame chart and use it in conjunction with all the benefits of trading on a non-time-based chart, which is the Renko. And what the Renko optimizer does, it delivers the optimal setting for you across your matched timeframes below. It's just a very powerful way of using multiple timeframes combined with multiple non-timeframe, if you like, in terms of Renko. And we use the same approach for tick charts as well. Again, tick charts are non-time based. They will work on the number of ticks set to the chart and not on time. So again, they will deliver a view on momentum. When the market is fast moving, these Renko charts move very quickly. When the market is slow moving and sluggish, like it is at the moment, they will move in a very sluggish way. And it just gives you a raw view of momentum, the speed of the market as it speeds up and slows down. It's very powerful. A lot of our customers use this layout for that particular reason, trading futures, trading all sorts of futures, particularly the indices though, and currency futures. It's a great way to trade those markets. I'm going to wrap up there because we've been going a long time. Let me just pull up, just one final thing just before we move off to where all the bits and pieces are. This was something else I meant to show you earlier on. I won't dwell on it too long, but it's a very unusual relationship that we have. This is another Renko. This is we're back to Aussie dollar here. This is a typical Renko chart, very similar to the one you saw on NinjaTrader there, with the bricks that you would imagine built in the same way. So this is non-time based. The problem you have with a Renko chart when you're trying to tie it into a time-based chart, it's actually quite hard to match it up because, as I say, these bricks are not formed at the same rate these are. So this is a non-time-based chart. So the bricks here, it's very difficult to match them up. So what we developed was something called a time accurate version. And if I just click on that, now what you're seeing is actually the time accurate equivalent. In other words, these bricks here tie up to what is going on precisely in terms of the price chart. And you get a much more smoothed, if you like. You get these nice sort of soldiers of bricks, if you like, building into these chart patterns. So it's less noisy, it's much more considered. And as I say, you are basically matching the front end with the front end, and it tells you what the size of the bricks is down here. Again, it delivers them optimally for you. So it delivers the optimal brick size. But I just wanted to show you that very quickly. It's hugely successful, this indicator. We do sell a lot of these on TradingView because you've got these two functions. So you can switch between time accurate, or you can have the regular chart, a regular Renko chart, whichever you prefer. But it's unique. There's no one else out there has it. And it just gives you this very clear patterning in terms of the Renko as it builds, so you do away with the noise. Very quickly, just to show you where all the bits and pieces are. If you're not already a customer of Quantum Trading, you just go to quantumtrading.com. This is where you'll find all the indicators, TradeStation, TradingView, NinjaTrader 7.8, MT4.5. You can invest in one, or you can invest in the whole package. As I said earlier on, if you buy the whole package with us, then you get all future indicators we develop for that platform free of charge. It's as simple as that. There's no questions asked. It's simple as that. You can move from one platform to another at any point. So your investment is always protected. If you started with MT4.5, for example, and then decided, okay, well, actually, I want to go to TradingView, I want to go to NinjaTrader, fine. If it's an equivalent indicator, we just transfer. We don't charge you. There are some companies out there which charge their customers to transfer their indicators, which I think is a disgrace. That's only my personal opinion. We've never charged you ever, and we never will in the future either. So, you get 24/7 lifetime support, and our support is 365 days a year. We support you at the weekends. We support you at high days and holidays. We're always there to sort out if you have any issues. If you've bought an indicator from us in the past, or you become a customer in the future, and then you decide you want to upgrade, we always give you a full credit for those indicators. So if you wanted to go from one to a package, or perhaps you wanted to go to a full package or a bundle, whatever it is, you will get a credit. It's as simple as that. No questions asked. This is where you'll find Anna. You'll find all the signups for Facebook, for Twitter. All the books there are up on Amazon in both Kindle and also in paperback. Hugely successful. We are very humbled by the number of 5-star reviews we get, and also a lot of the comments we get as well. And we do have this published as well in a lot of countries, particularly in the Far East. We're in Thailand, we're in Japan. It's been translated into Japanese, Chinese. We're in Vietnam. We have another publisher there as well. We've been approached by a publisher in other countries as well, also at the moment, who we're talking to. So it's been hugely successful, and we're just very humbled by it as well. You'll find all the links here over onto the various sites and a lot of the box sets down there too. Finally, just onto the Forex program. We have a huge number of Forex students now on the complete Forex trading program, which is soon to be joined by the complete stock trading program, stock trading and investing program. The Forex program is just that. It is the complete program, and the same will apply to the stock trading program. It will be everything. It will include all the indicators. It will include live webinars with us once we get up and running. In terms of the Forex program, we bolted in the funded program last year. You basically trade our money. It's as simple as that. And we put that in because it gives our students an upgrade path. Once they've completed, and they can join, you can join at any time the funded program as a one-off fee to join, and you literally join on the evaluation stage, which is down the bottom here. You can join at a level of your choosing. You can start with a $5,000, $10,000, or $15,000 account. You are trading our money. You're not trading your money. There's a one-off fee to join. It's as simple as that. And you're then trading our money. Yes, there are rules. Of course, there are risk and money management rules. Once you start at this level, if you started at 15,000, once you've achieved the target, you get a kickback of the profits. You then start moving up the next levels. We multiply that capital by 4. So if you started at 15, you go to 60,000, and thereafter we double it. So you go 60, 120, 40, 80. We go all the way up to a couple of million. And you work your way through the various levels, and throughout that process you get a kickback in terms of 50% or 60% profit, depending on which level you are at. Again, hugely successful. A lot of our students are on that program as well. We will try and do something similar with the stock trading program, but it's a little bit more complicated, as you can probably appreciate. So that's it, done. Are there any more questions? Let's just have a quick, okay. There we go. Thank you very much indeed. There we go. That's it. Right. I think we're up to date with all the questions. Hope you've enjoyed the session today. We will be back with another session next week, probably. So thank you very much indeed for coming along and joining us today. We've overrun a little bit on time, but there we go. That's what we like to do. We always over-deliver anyway. So hope you've enjoyed it. Thank you so much. Enjoy the rest of the trading week, and we will see you again next week, probably. And wish you all well. Hope you're all staying safe, and see you again soon, and bye for now.